Nobody can predict the future price of the stock market, but that doesn't stop many investors from trying. Study after study has shown that market timing does not work and that time in the market is the way to go. Based on this, investors should safely assume that it isn't likely to be systematically successful at stock picking and/or beating the market over a long period of time. Hi, my name is Koby and I'm an investment advisor. If you're new to my channel, I focus on helping Canadians smartly invest their money, safely build wealth while paying fewer taxes. In today's video, I will tell you why you should always assume that capital markets are efficient and how this information should influence your investment decision-making process. If investing and wealth creation is something you're interested in, make sure to like and subscribe. It costs you nothing and you'll be notified whenever I upload a new video. So let's jump right in. The efficient market hypothesis believes that efficient markets are ones in which asset prices always fully reflect all available information. Now, before we discuss whether this hypothesis holds in reality or not, let's quickly review how the price of securities is determined. The financial markets are auction-based systems. Buyers and sellers of securities are competing to execute trades at the best possible price. In a competitive market with lots of independent buyers and sellers, we would expect buyers to buy securities that they deem to be worth more than what they paid for, based on their preferences and information available to them during that point in time. On the other side of the trade, we expect the sellers to believe that the price they sold their security for is worth more than their actual intrinsic value, which is also derived from information available to them at the time of sale. A good question savvy investors should always ask themselves before they buy or sell stocks would be who is on the other side of the trade, and more importantly, what information do they have that I don't. Investors can fall victim to a wide range of psychological and cognitive biases. A common one is information bias, which can result in them overstating or understating the cost of a security because of the assumption that they hold information that others don't. If you want to know more about information bias and other common biases that can impact your investments, I've added a link to a video I made in the description below. The competition between investors with different interests and opposite views, buyers and sellers, in liquid markets makes prices reflect all market participants' expectations. The price is essentially becoming the result of all available information about fundamental values and expectations from all markets participants. Every market participant wants to make a profit by bringing new information to the market. The challenge is that any market participant with new information are unable to interact with the market in isolation. They also cannot know about all of the new information that other market participants may be bringing to the market at the same time. And even beyond that, they do not know how other market participants are going to reflect their new information in the security price. The result is a market that reflects the information in prices while making it extremely challenging for anyone to profit consistently by identifying and trading on new information. The efficient market hypothesis, or EMH, as mentioned earlier, is a hypothesis in financial economics that states that asset prices reflects all available information. A direct implication of this hypothesis is that it is impossible to beat the market consistently on a risk-adjusted basis, since market prices should only react to new information. If you, as an investor, believe this hypothesis is true, you will choose to invest through low-cost ETFs versus using actively managed funds. Mutual fund managers use company-specific research and different pricing models to try to pick winner stocks in order to generate excess risk-adjusted returns, also known as alpha. The best way to know whether you should choose low-cost ETFs, which means you believe that the market is efficient, or whether you should pay the premium in the hopes of getting the desired alpha over a long period of time, is by analyzing the data collected over the years. The French mathematician Louis Baclier was one of the early researchers on this topic. His early 1900s random walks theory describes a path that consists of a succession of random steps on some mathematical space. This was one of the foundations that later led to the development of Eugene Fama's efficient market hypothesis. 50 years later, in 1953, Maurice Kendall, a British statistician, published his research and suggested that the movement of shares on the stock market was random, meaning it is as likely to go up on a certain day as it is to go down. In 1965, Paul Samuelson brought forward the idea that in a well-functioning and competitive market, we would expect prices to change as investors' expectations adapt to new information. This theoretical explanation is called the fair game model. In 1970, Eugene Fama published his now famous paper, Efficient Capital Markets, a review of theory and empirical work. Fama was able to formalize an empirical approach to testing the theory of market efficiency. Now, it's important to note at this point that Fama never claimed that the market is perfectly efficient. The real question, which takes us back to comparing low-cost ETFs to high MERs mutual funds, is whether inefficiencies can be consistently exploited and can alpha be generated without taking on additional risk, and more importantly, make it justifiable for investors after paying management fees. As investors, this is all that really matters. The efficient market hypothesis is not a law or a fact. It is a hypothesis. In strictly scientific terms, the efficient market hypothesis is false, but in practice, it is as true as it can get. Now, in terms of formulating your investment decision-making process, the efficient market hypothesis is by far the strongest hypothesis we have to date. That's it for today's video. I hope you found it valuable. If you haven't done that already, make sure to hit the like button. And if you want to see more, don't forget to subscribe. If you know anyone who can benefit from this video, please share it with them. If you have any questions or comments, please let me know below. I read and reply to every single one. Thank you very much for watching, and I will see you on my next video.